Hello and welcome to the Business Standard Morning Show. I'm Ishan Gera and here are the stories for the day. In a departure from the stand taken by its big four rivals, EY last week said that it was planning to split the firm's audit and advisory businesses, even as the other three of the group, Deloitte, KPMG, and PricewaterhouseCoopers, were adamant on keeping the two services together. EY said that it was doing so to address regulatory concerns over potential conflicts of interest. So, will this move prompt others to follow suit, and will its ripples be felt in India too? Watch our next report to find out.
London-based EY, the third largest of the big four accounting firms, has said it is moving ahead with plans to break the firm into two companies. This will create an $18 billion revenue audit firm and a separate but larger and faster growing $24 billion consulting arm. The audit business will retain the EY name while the advisory firm will don a new brand identity. The firm's 13,000 partners across 140 countries, including 550 in India, will vote on the proposal later this year. EY Global said leaders at its 15 largest member firms, accounting for 80% of total revenues, have unanimously supported the strategy. EY's Greater China members have refused to come on board. If successful, the move would mark the biggest shakeup in the sector since the collapse of auditor Arthur Andersen in 2002 because of the Enron accounting scandal. It reduced the Big Five to Big Four. Accenture, which was split off from Arthur Andersen and listed in 2001, is now worth $183 billion, up from $6 billion at the time of its IPO. A split of EY would result in multi-million-dollar cash payouts to audit partners by the newly created consulting unit and stock awards to consultant partners who move out. Reports said the consulting business will go for an IPO with plans to raise about $10 billion by selling a 15% stake. It will reportedly borrow another $17 billion, much of which would be used to pay off the partners at EY's traditional auditing business. The breakup will ease pressure from regulators to avoid conflicts of interest arising from EY providing non-audit services to audit clients. EY's big four rivals have also been facing pressure to break up their audit and consulting practices.
So the one attempt which was made earlier, which was the only predecessor to EY, was the Accenture thing, where Andersen Consulting split and then converted itself into Accenture. So in some sense, I think this is a very, very radical thing. And this is also a value unlocking exercise. Regulators have been pushing for this. Until now, the Big Four have said it is not practicable because when you do audit, you also need to do forensic, some bit of it, you need to do a SaaS, you need to do tax, all of that. And therefore, having all of that under one roof, there was one argument which was put. Now that one of them has shown that they can exist without having to do all of these together, the regulators might push the others also. So it is path breaking. It is something which will have a ripple effect. Will that force the likes of McKinsey's, the likes of BCG, others to also have a relook? The answer is probably yes. There are two, three issues which are very, very critical. One is on the tax practice. Apparently, some part of the tax practice will continue with audit because that's compliance driven. Other is going to go to consulting. How will that happen? If both are again competing with each other on audit, how will that happen? Those are some of the things which will be interesting. But none of these operational difficulties are going to be showstoppers.
EY Global CEO Carmine Di Sibio said the separation could bring in an additional $10 billion a year for the advisory business and consultancy fees from big tech companies, as the business will be freed from the conflicts that bar it from winning work with EY's large audit clients.
The move clearly is motivated by reasons that you are able to address the situation of conflicts better. It's also motivated by the reason that your ability to raise money from the public will help you grow your non-audit advisory or consulting business I clearly see the advantages. Once you split the ownership and there is no commonality or economic sharing between partners of both the sides, then you clearly have no conflict. So the non-audit practice of EY, let's take that as an example, would be able to pursue work with the audit clients of erstwhile EY.
EY CEO DCBO said conflicts become harder to manage as firms get bigger. He believes that other Big Four firms like Deloitte, KPMG and PwC will have to split their businesses eventually. However, the other three have refused to follow EY's lead in breaking up their businesses and indicated continuity with their current business models of providing a mix of audit, tax, advisory, legal, and other professional services under one roof. Once brought into effect, EY's decision may lead to sweeping changes in the audit and advisory sectors. While it may prove to be a value unlocking exercise for some, others may face enhanced competition. It remains to be seen whether the other Big Four firms will change their stance anytime soon or not.
Big organizations like EY always think ahead of the curve to remain competitive, and they always have a contingency plan. But Bangalore's authorities had no plan B ready when the city's roads and streets were flooded. A man swimming in the living room of his villa in the upscale Epsilon area, CEOs taking tractor rides to reach safer places, visuals emerging from India's Silicon Valley were just plain shocking. So today we ask if brand Bangalore has taken a hit.
Just a few days of rain changed everything, exposing the crumbling infrastructure of crammed Bengaluru and washing away the tall claims of authorities. As roads disappeared under muddy floodwater, motorboats had to be used to rescue people from their homes. Their luxury cars, from BMWs and Range Rovers to Bentleys, were left behind, half submerged. Fish were spotted on highways and people were seen swimming in their living rooms in the posh colonies of Bengaluru, the capital city of Karnataka and India's IT hub. These stark visuals of flooding inundated social media too. Life came to a standstill in Bengaluru's key outer ring road area, which houses more than 700 companies, including offices of big international ones like Microsoft, Intel, Goldman Sachs, and Morgan Stanley. Many of these companies have had to allow work from home or pass on important work to locations outside of the city. While companies usually have business continuity plans involving such steps, they have still paid a heavy price. The Outer Ring Road Companies Associations has reportedly claimed that the flood caused a loss of 225 crore rupees to the IT and banking companies it represents on the 30th of August alone. In a September 1st letter to Chief Minister Basavaraj Bommai, the industry body asked the government to come up with short-term and medium-term plans to address the issue, stating that concerns about Bengaluru's future growth were being raised across the world. The letter warned that companies may leave if the infrastructure issues were not addressed. The contents of this letter should raise alarm bells. Why? Let's let the numbers answer that question. IT and IT-enabled services remain one of the top services exports from India. Close to 50% of the total services exports comprise IT exports. India's services exports set a new record of $254.4 billion in FY22, beating the previous high of $213.2 billion in FY20. According to the Karnataka Economic Survey, the state contributed an estimated 38% to India's FY22 software exports, which were estimated to be worth $170 billion. According to a recent report by INC 42, Bengaluru has clinched the title of India's top startup hub. It added that within India, Karnataka topped the list of states in terms of startup ecosystem development, with $62 billion in funding. Meanwhile, Delhi NCR attracted $39 billion and Maharashtra $20. The stakes are high when it comes to Brand Bengaluru's future. India's startup success story has been touted across international forums by the government, which is also counting on the ecosystem to generate much-needed high-quality jobs. India also has an ambitious services export target of $1 trillion by 2030. The continued growth of the IT industry, and by extension that of Bengaluru, will be a necessary condition for achieving this goal. But now there are fears that the city's technology capital image could be in deep water, and the brand image has indeed been dented.
Bangalore's brand is being hurt by these reports of flooding, bad governance and corruption. A very large number of tech companies with around 10 lakh people being employed is along that outer ring road stretch. It has some of the largest, most well-known companies in the world. Any city in the world, any country in the world will be very proud to have so many people employed by such great companies in the city. Sadly, in Bangalore, many people in Vidhan Soudha, the seat of government, take it for granted since illegal constructions have come up in the Raja Kalaways, which are the big drains connecting one lake to another. That entire area was a lake area. The lakes have been breached. And when it rained heavily, being low-lying areas, water accumulated, then flowed through the Raja Kalaways to another lake downstream. Now, since you're blocked, water is accumulating there. The result of corruption, politicians getting the real estate business, flouting the rules, and lack of governance. But we are emboldened by the fact that the Chief Minister has acknowledged that things have gone wrong and has announced a series of steps. We hope the Chief Minister set up a high-powered committee under an additional Chief Secretary to ensure that his promises are carried out and work is done. The world is watching what the government will do to remedy the situation.
But Bengaluru can still salvage the situation. A senior IT services veteran based in Bengaluru told Business Standard that when he spoke to 5 large Fortune 500 firms, none said that the recent flood would make them move out of the state or the city. The National Association of Software and Service Companies also appeared to be committed to staying put. Last week, a NASSCOM-led consortium of software companies met Karnataka IT and BT Minister CN Aswatha Narayana to discuss the way forward. State officials have agreed to have IT sector participation in governance mechanisms planned for Bengaluru's tech corridors. The officials will also hold a meeting with the industry to discuss plans once every fortnight. Advertising guru Prahlad Kakkar said that Bengaluru's image as a cosmopolitan city had taken a bit of a beating. But he added that this was a problem that also plagued other cities in India, including Mumbai, where flooding is routine. Kakkar concluded that the underlying causes would have to be addressed seriously if Brand Bengaluru was to emerge again as a vibrant city. What is clear is that if the authorities have the will, the city can definitely brave the deluge and emerge stronger than before.
Forecast of heavy rain is also keeping the country's financial capital on the edge. Mumbai also sees regular flooding. Moving on, the Nifty mid-cap and small-cap indices have leaped up 23% since their June lows. Even though the valuations seem mildly stretched post this rally, analysts believe this broader market rally is here to stay. Watch this report.
The rise in mid and small cap stocks has been meteoric since their June lows. While at the index level, the Nifty mid-cap and small-cap indices have jumped over 20% since then, individual stocks have zoomed as much as 94%. In fact, 464 of the Nifty 500 stocks have given positive returns since June lows, led by Adani Transmission, Tube Investments of India, Mazgaon Dock Shipbuilders, Adani Total Gas, and JSW Energy. Sectorally, most of the stocks that gave returns of 40% and above were largely from the housing finance space, banks, clothing and footwear companies, quick service restaurants, consumer durables, and auto ancillaries. And analysts feel there's more steam left in this rally.
If you look at it on a 1 year, 2 year, and even a 3 year time frame basis, the Indian markets kind of stand out as compared to the rest of the world. And I think that's driven by the fundamentals of the economy. When you look at the PMI manufacturing data, when you look at the credit growth, when you look at the way Indian currency has kind of stood out against the dollar as compared to the rest of the currencies, when you look at the asset quality in the banking system, when you look at the government capex, inflation trajectory, I think everything tells you that the Indian economy is on a very, very strong footing. The fact that we are going to continue to remain one of the fastest growing economies in the world is propelling the FIIs to come back and the flows to come back in the manner in which they have. And I think this bull rally is here to last. Investors would do well to invest in India from a 2 year, 3 year perspective. There is a lot of money to be made in equities in India, and I would invest in quality stocks across market caps, large, mid and small.
The record Demat account tally too is a reflection of the confidence that investors have in the Indian economy and markets. Last week, the country's Demat account tally topped the 100 million mark for the first time, with over 2.2 million new accounts being added in August. That said, valuations seem to have stretched a little, especially in the mid-cap segment, post the steep rally over the past few months. By the end of August, the Nifty Mid-Cap 100 was trading at 23.2x, an 18% premium to large caps. The Nifty Small Cap 100, on the other hand, was trading at 17.2x, a 12% discount to large caps. Analysts, however, think that sustainable strong double-digit earnings growth will be able to justify the premium valuation. For G. Chokalingam of Economics Research, there are several segments which offer valuation comfort in the broader markets. Among insurance, HDFC Life looks attractive. A few high-quality PSU banks are also below their adjusted book value, while some pharmaceutical companies offer scope to accumulate at current levels. Against this backdrop, the broader market's performance will be on investor radar this week. Investors will track August inflation data for India and the US and other global cues before taking trading decisions. In the primary market, Tamil Nadu Mercantile Bank is expected to debut on the bourses, while Harsha Engineers will open their IPO.
Meanwhile, a new trend is taking social media platforms by storm. It has triggered a debate around work culture. How much hard work should we put in? Should we go beyond our job description? Should we do only what we have been told or volunteer for extra work? Whichever way you choose to tilt, you cannot ignore quiet quitting. Our next report tells more about it.
Social media users have been coming across a term called quiet quitting for quite some time now. It is everywhere, from Instagram Reels, tweets, and even on Twitter videos. People have associated the term with laziness, but the concept goes beyond this simplistic definition. But before we delve into its details, let's find out some background. The COVID-19 pandemic saw a major change in the way people work. With working from home becoming a norm, various studies showed how employees were unable to maintain a work-life balance. A report by a national daily stated that the burden was more on women. With this, people's expectations of their jobs also changed. They no longer want to work at places where the pay is less and work hours undefined. Anthony Klotz, a faculty member at the UCL School of Management, coined the term the Great Resignation to define the phenomenon. Since 2021, companies across the globe are witnessing high attrition rates as work conditions and pay become top priority for employees. This phenomenon is more pronounced in Indian IT companies. Quiet quitting takes this a step further. Quiet quitting is often confused with quitting the job altogether, but it's not. It is defined as performing only the jobs assigned to an employee by the employer and not going above and beyond the job description. People have been taking to Twitter to share how setting boundaries at work has changed the game for them. The concept of quiet quitting stands exactly opposite to the hustle culture. Under that, the employees are encouraged to make every moment count and work hard to earn money as well as promotions. With quiet quitting, employees discourage practices like checking their emails outside their work hours, etc. So, is quiet quitting a new term? Well, no. A report released by Gallup showed that only 20% of the employees are truly engaged in their work. Others have been practicing quiet quitting for a long time.
I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Bombay Shaving Company CEO Shantanu Deshpande recently said that freshers should throw themselves into the job. They should eat well, stay fit, and put in 18 hours every day for at least 4 to 5 years. But not everyone agreed with him. That's all for today. For more news and analysis, log on to businessstandard.com. We'll be back tomorrow with our next episode. Thank you for watching.
If you liked this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.